What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Hello, everybody. Happy Thursday. The situation in Hong Kong is becoming more concerning by the day. On yesterday, the highly densely populated city recorded 4,285 new confirmed COVID-19 cases as health authorities continue to struggle with confirming a backlog of preliminary tests. 9 died in the previous 24 hours, including a 100-year-old woman and a 3-year-old girl. We remember that experts warned at the start of the week that cases will likely reach 20,000 a day within 10 days. The city has relatively low vaccination rates and a relatively old population. For the first time since the onset of the pandemic, hospitals in the Special Administrative Region are beyond capacity, with wait times of up to 8 hours at emergency rooms. One Washington Post reporter on the ground reports that at one hospital designated to treat COVID-19 patients, a security guard at the outdoor triage area said people have been waiting for up to 5 days at that particular spot to get test results before they are sorted into isolation facilities. Local Hong Kong media report that there were some 12,000 patients who had tested positive or preliminary positive and were waiting to be admitted into hospitals or quarantine facilities. And of course, the situation now has the full attention of Beijing. State-backed local newspapers ran the same report yesterday on Wednesday, stating that Xi Jinping had issued quote-unquote important instructions for Hong Kong. Influential mainland voice on Hong Kong affairs, Beijing-based law professor Tian Feilong, someone who we have quoted before, spoke to Western media yesterday, articulating what many fear Beijing officials are thinking. Quote, "The loopholes and oscillation in Hong Kong's antivirus strategy show that some officials have not met the requirements of firm patriotism. The Hong Kong government still has some insufficiently loyal or two-faced officials. There should be further steps to eliminate them from the system." End quote. Next up, let's touch on a few important economic and financial updates from the last few days. According to data from the National Bureau of Statistics published yesterday, Wednesday, China's inflation slowed in January of this year, providing policymakers with more space to employ fiscal and monetary mechanisms to shore up the economy ahead of the upcoming politically sensitive Party Congress. The producer price index rose 9.1% from a year earlier, weaker than economist forecasts of a 9.5% increase, and down from 10.3% in December. Consumer prices grew 0.9% last month. This is year on year, slower than a projected 1% increase. Independent analysts believe, based on alternative models, that the reported inflation level is relatively accurate. Financial outlet Caixin Media reports that a unit of Beijing-based private equity giant Hill House increased its exposure to 2 US-listed Chinese new energy vehicle makers in the fourth quarter of 2021, while offloading shares in internet giants Alibaba Group Holdings and Bilibili. Quotes, "The adjustments in its investments revealed in a filing to the US Securities and Exchange Commission Monday likely reflect investor concerns about the Chinese tech sector's prospects after last year's domestic regulatory onslaught and expectations that China's surging NEV market will offer better returns." End quote. Hill House said it was unable to comment on changes to the portfolio. We also learned yesterday that Nasdaq-listed Chinese online travel giant Trip.com will soon allow its 33,000 employees to work outside the office at least some of the time during the week. While this shouldn't sound particularly unorthodox to many viewers, particularly those viewers in developed economies, in China it is sort of a big deal, especially in the technology sector, which has been notorious in recent years for toxic overwork cultures. As someone who worked for a technology company in Beijing for a period of time, albeit in middle management, I can attest to the accuracy of this reputation. Starting March the 1st, just a few weeks, Chinese mainland employees of Trip.com will have the option of applying to work remotely for 1 or 2 days, Wednesday and Friday each week. By the way, guys, if you're enjoying the content, don't forget to hit the like button. It's a huge help for a small channel like this. And if you're watching for the first time and you enjoyed the content, you get some value from it, maybe consider subscribing. Okay, moving on. General Secretary Xi Jinping, who interestingly has not appeared in public since early last week, had a phone conversation with French leader Macron on yesterday. According to state media, quoting them now, Xi Jinping stressed that related parties should stick to the general direction of political settlement of the Ukraine issue. He also emphasized that related parties should make full use of multilateral platforms, including the Normandy format, and seek a comprehensive settlement of the Ukraine issue through dialogue and consultation. End of the quote there. While the world has been following the Ukraine crisis closely, the People's Republic of China state media apparatus was initially quite muted on the situation, then in recent weeks has maintained a relatively restricted narrative, which is basically that this crisis was caused by the United States / the West, provocations against Russia. Beijing has been publicly supportive of Russia, hosting leader Vladimir Putin last week, but its language of support has been vague, expressing things like, "We strongly support Russia's legitimate interests," etc. Some Chinese experts have spoken to media outside the mainland, however, especially this week. For example, Shi Yinhong, an international affairs professor at Renmin University in Beijing, speaking to Hong Kong media, expressed yesterday, quote, "If a war breaks out in Ukraine, the United States will realistically have to reduce its attention and resources to China and the Indo-Pacific. But on the other hand, the war would be a huge step down the path of radicalization in world politics, and doomed to inflict great pressure on China for an arms race, as well as Taiwan and the South China Sea." End quote. During the phone call, the two heads of state also discussed trade, with Xi Jinping expressing, quote, "China stands ready to work with France to advance the ratification of the China-EU investment agreement and its entry into force." End quote. We remember that the investment agreement was signed by both sides in late 2020, but failed to be ratified in 2021 due to the deterioration in EU attitudes towards Beijing over a series of concerns from Xinjiang to Hong Kong to wolf warrior diplomacy and Lithuania. Interestingly, the French readout of the phone conversation included the line, quote, "He, Macron, encouraged China to lift sanctions against Lithuania and to address Chinese demands through dialogue." End quote. The Chinese statement included no mention of Lithuania. And last up, the Evergrande Housing Crisis. A couple of quick but important updates. In recent weeks, we have seen a lot of modest regulatory easing in the housing sector from top policymakers. However, analysts across the board continue to stress this week what we have been saying here all along. This won't be enough to arrest the slowdown. The property market was too over-leveraged. Modest regulatory easing won't be enough. Demand has collapsed and financing is too tight because no one wants to give capital to these crisis-hit firms. For example, yesterday, one executive from a small property firm speaking to domestic financial media expressed that although the central bank has eased monetary policy and regulators have relaxed some policy curbs to shore up the market, firms are still struggling with weak demand. Quote, "Home buyers lack confidence. Real estate firms can finance, but if everyone stops buying houses, how can they survive?" End quote. Analysts at Guotai Junan Securities Co. Limited wrote recently that China's urbanization has less room for growth than before, so long-term demand for housing is at risk of falling. Quote, "In the short run, the fallout of the COVID-19 pandemic has not only caused a drop in many people's income, but also added to their concerns about the instability of future income, weakening their willingness to buy homes." End quote. Meanwhile, moving from the forest to the trees, according to a filing by state-owned Shanghai Construction Group, a Chinese court has ordered the freezing of 640.4 million RMB, just over $100 million in assets held by a subsidiary of China Evergrande Group. This is not the first time this has happened either. Shanghai Construction Group, which is the same firm that which sued Evergrande in the southwestern city of Chengdu late last year, also froze more than 360 million RMB of assets of a different Evergrande unit for a different project in Jiangsu province last week. The increasing numbers of legal actions launched against Evergrande and the resulting asset freezes are like a death by 1,000 cuts for the developer, and it's not going to stop either. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.